joined by Daniel Hynes, Senior Commodities Strategist at ANZ. Daniel, thanks for your time.
My pleasure.
Firstly, how important is it from a commodities team and a strategic team to have people on the ground in key markets that you're going to be giving commentary on?
Oh, it's absolutely key. I mean, as a commodity analyst, to have people on the ground that we can talk to quite regularly and get a feel for what is actually happening on the ground is paramount. I mean, there are obviously a lot of news about certain issues going around, and to get a cross-check and a snapshot of what really is happening is absolutely key. I mean, we have very strong relationships with a lot of key end users in the market. So for us, being a commodity driven bank, that is really important for not just ourselves, but also obviously for our customers, particularly those ones who are feeding that behemoth from Australia.
From a supply chain perspective, I assume having the people along the chain is important as well?
Yeah, absolutely. I mean, clearly here in Australia, we support the local industry quite strongly, but then have I suppose parts through that supply chain, through the shipping, for example, of that material to China, and then obviously supporting businesses there in China itself through to that end-use customer. So that gives us a sense of when issues crop up, like the coronavirus at the moment, we get a sense of where it's really impacting. Is it back in Australia, or is it further along the line more towards the customer? So it does give us a really strong and clear sense of where the issues are.
Putting together a presentation or putting together a view on the commodities sector can change rapidly, but have you been surprised at how rapid the change in the commodities market has been, given what's happened in the last 4 weeks?
Well, to be honest, no, because sometimes I wake up and I don't know what's going to happen that day, let alone the next month. But certainly the change in sentiment from the start of the year to now is really chalk and cheese. I mean, we came into the year quite positive. It had a tough 2019, and then we saw the trade deal between the US and China signed. There were economic data pointing to a pickup and rebound in activity. So 2020 looked relatively promising, and then obviously the coronavirus hit, and that's all been thrown out the window. And it's really hard at the moment to get a sense of where it could go, because no one really knows how long this epidemic will last, and so we have to be on our toes, really. I suppose crunching those numbers and looking at scenarios, but it's been quite a significant change.
From the start of the sort of the public outing, if you like, of the coronavirus to now, what impact have we felt right now? Forget even looking forward, what's the current impact that we've seen?
At the moment, it's been really held domestically within China. Certainly, a lot of our customers here in Australia haven't seen any significant impact to their business just yet, but certainly when we talk to our customers in China itself, there's certainly been delays. They're seeing obviously the restriction in travel really hurt manufacturing, so in a lot of cases they may be operating at less than 50% at the moment. But also, they're starting to see inventories build up, and I suppose that'll be the crunch point when it'll start to impact people further down the chain, is when those inventories really start to fill up in China, but we haven't seen, I suppose, the manufacturing and industrial activity really pick up there, and that will then feed through to the wider international market.
Like you say, being an organisation such as yours that do crunch the numbers, that do look at the scenarios, what are some of the scenarios looking like?
Well, you could paint pretty much anything at the moment. I mean, certainly this current quarter we're expecting to see economic growth in China fall by half in Q1, so from 6% to around 3%. After that, it's really how the Chinese government can recover and reactivate, I suppose, the industrial sector there. And I think from our perspective, it's looking more and more likely that this will be an issue which is going to drag on for some time. The ability of the government to really pump a lot of money into the marketplace is significantly reduced compared to previous down cycles. But more so I think going forward, it's the size and influence of China within the commodity markets that are really going to make a difference. And this type of disruption doesn't just disappear overnight. So yeah, for us, it's going to be, I think, an issue which is going to impact commodity markets for a while yet.
So there's an expectation, I think, in the wider market that when this resolves itself, and we all hope it does, that the switch will be flicked and it'll just turn on, but at 3 times the pace to catch up. Is that a view that's probably a bit misguided?
Yeah, I think so. I mean, the government is certainly wary of pumping a lot of money back into the system and inflating asset prices. We saw the issue that created in the last down cycle, sort of in 2016, and I think now the government there is still mindful of deleveraging the whole economy over the longer term. So while they'll want to pump a little bit in initially, I think they'll certainly be a lot more constrained compared to the past. But outside of that, I think the industry itself, is probably constrained a little bit more as well. Capacity has been wound back in a lot of industries, particularly in the steel industry. We've seen capacity cuts as well. So, there is certainly some spare capacity there at the moment, but not enough to really, I suppose, boost economic growth to the levels that we'd need to see to recover from what we've lost so far.
When things like this arise, there's always winners and losers in the commodities market. Are you seeing any, or are you predicting any obvious winners and obvious losers?
Yeah, I think certainly from a trade point of view, I think marketplaces outside of China certainly would be eyeing this as an opportunity to take share away from China itself. We saw that emerge last year with the trade conflict and obviously the tariffs placed on US goods and Chinese goods into the US. So US consumers, for example, or manufacturers have certainly been scouring the Asian marketplace for alternate sources. And I think if this certainly weighs down manufacturing in China again even more so, then that will be accelerated. So I think countries like Vietnam and Philippines and even Korea and Japan will potentially benefit from a weaker China, I suppose, if this issue does drag on.
And in a commodity perspective?
Certainly, the ones really interlinked to industrial activity will suffer. So you have to point to base metals in particular as ones which could see demand really hit here. The other one is certainly on the energy side, and LNG stands out as one for Australia which could be impacted. It was a fairly soft market coming into this period, and so now we're hearing and seeing a lot of consumers in China really pushing back on some of those volumes that are coming through at the moment. So that's clearly one under pressure. The other ones I still think will be well supported. I think crude oil should still benefit, and certainly the trade agreement called for a significant pickup in purchases there, and also iron ore and steel. I think any sort of stimulus we do see will hit those markets quite quickly. So I suspect they'll be beneficial there.
Interesting times for a commodities strategist. Daniel, thanks for your time.
My pleasure.